That I am late. I'm going to give just a minute to let people join here. I am going to be talking today about different income streams and why and when you might want to split your income up between those income streams. So let me share my screen here and we can jump in. Just pull this up. Okay, we have basically two main reasons why you might want to split up an income stream. So generally speaking, the entity structure format is going to look something like this. We're going to have the individual filing their 1040, and then we're going to have an LLC, and that LLC may or may not elect a filing status. If the LLC has elected to file as an S corporation, then it will file its own separate tax return and issue a K-1 up to the owner. Now, that in and of itself gives you, the owner, two different income streams. Instead of having a single income stream as self-employment income, now you have the business profits, which are reported on a K-1. And you also have a W-2 from the business, so wages. So that's two different income streams, but that's not really the emphasis of what this training is. This training is saying, when would you want to take that single LLC and split it up into multiple different income streams, into either different entities? Well, generally, it's always going to be different entities. But when do you want to sort of take this one thing that really is kind of one income stream and break it apart? And what, under what circumstances, and then what are the benefits of doing that? So that's what we're going to go into today. And really, there are two main reasons why we would want to break up income streams into the smaller pieces. The first one is to take advantage of lower tax rates. And I am going to go into some examples of when that would make sense here in a minute. And then the second one is to qualify for deductions that you couldn't take under the single business for any number of reasons. So let's talk about deductions first. I'm going to go first with deductions. So I'm going to use myself as an example here. My main business is doing accounting and tax work. So with that, there's some things that I would like to deduct that I can't take as deductions because they're not ordinary or necessary for like an accounting firm as expenses. So what do? I come up with other entities for which those deductions would be ordinary and necessary. The most common example on this comes to things that we kind of want to buy personally, but that we can't take as normal business deductions. So recreational vehicles are a big one. I'm going to put RVs. That stands for recreational vehicles. Doesn't necessarily mean motorhomes, though those could apply. So I'm going to jump back up, or I'm going to go back to this idea of entity structures. And I'm going to redraw some of this. Actually, I think I can cheat and just grab that. There we go. Copy. Paste. There we go. Okay, so there's a story I often tell about a client who was a dentist who wanted to buy a tractor, and so he had a setup very, very similar to this. It was a dental practice, right? But an S corp, and he wanted to buy this like Kubota tractor as a hobby tractor, but he didn't have there's no way a tractor is going to be ordinary and necessary for a dentist office. So what he did is he actually was going to be, wanted to purchase the building anyway that he had his practice in. So he set up a new LLC and ended up purchasing the building through that LLC, and then used this LLC to set up a family management company. Family management. And that LLC was managing now the building for the dental practice. So that shifted the business purpose of this whole entity from being a dental practice to being a property management company. So now he could go and he could buy this tractor. I'm not sure this is a good idea to attempt to draw a tractor, but all right, that could be worse. So he ended up buying the tractor under the family management company. And that allowed, because he split things up business wise, and instead of having one entity that owned the dental practice building, he had another entity that now received rents from the first company, from the dental practice, and then was able to take that deduction within that company. So he still isn't involving anyone outside of this, but within his own structure of what he has going on in his life, he was able to just break it apart so that he could create a new business that qualified for the deduction that he wanted to take, with that being an ordinary and necessary deduction under the new business. And there are lots of examples of this. This type of thing could apply for a second property. So, a beach house or a lake house or a mountain cabin or, whatever it would be. The key is really what's done most commonly here is that you set up some kind of a rental company. And that does not apply in this particular case because I guess it does apply because this was a rental company. Ultimately, it's a company that owned a piece of property and was renting it. It just happened to be that he was renting it to his own company. But a lot of times people will do this kind of a setup and allow some external rentals to create a genuine business. And that applies most often when we're talking about personal property, not real property. So common ones here are boats, change colors, boats, planes. I'm going to say RVs again, but this time I mean like motorhomes, and could even apply to, things like side-by-sides, like off-road vehicles. And if you create another entity, and this entity is a rental entity that is holding these assets and then renting them out, you can do some combination of renting them to your other business if your business has a business use for it, and or doing some limited rentals out to other people. Now, you don't have to do that if your main objective here is not to earn a lot of profit here. You can be very picky about who you rent it to, and you can kind of control that. But having this within a rental company now allows you to take that boat that you were going to deduct that you were going to buy, and put it in this rental company and actually rent it out and therefore deduct it. And this is the most common way to handle this kind of things, especially for high ticket items like boats and planes and things like that. Creating a separate company, a family management company that handles rentals. And this even goes down to if you're purchasing even other vehicles, like, let's say, you want to buy a sports car, something like that, or a collector car, and you want to figure out a way to manage the income associated with that. What we're really doing here is creating a company for which those purchases are ordinary and necessary as a part of ongoing business, and then managing the income to that company by shifting over some of the income from your other company. So this is one reason the deductions, why we might want to shift income around between different companies. The other type of deduction, so we talked about like, buying things that wouldn't be ordinary and necessary for the other company. But the other big one, and the other big reason why you'd want to set up some kind of a family management company to handle rentals or to handle real estate or to handle both and kind of do everything under that company would be if you are wanting to pay your kids for work that they do in your company. So paying kids is a really common strategy. It's one that we get questions about all the time, but it has to be done correctly. So if you pay your kids through an S corporation, then there really is no advantage to do that, because you're going to end up paying them either on a W-2 and you don't have any kind of exclusion for payroll taxes on a W-2, or you pay them on a 1099 and then they end up paying self-employment taxes on that anyway. So you generally don't want to pay a minor child under age 18 through an S corporation. You would do that through a family management company. And the reason why is because there is a specific, I don't like the word loophole because it sounds like, it sounds like we're getting away with something, but this is actually, this is written into the tax code. So it is a tax advantage specifically for a family partnership where either one or both parents are the owners of this LLC, and then they can pay kids through this company. And they actually, the way to do it is to pay them on a W-2, but there's an exclusion for payroll taxes as long as you're paying your own kids. But that only applies in a partnership entity structure, not in an S corporation. So you would pay the kids on a W-2, let's just say, $10,000. They did work for you. You actually track the work, add it up and pay them $10,000 for the work that the kids do for you. And then that becomes a deduction to the family management company. And the key here is that when structured this way, you're exempt from payroll taxes. So there's no Social Security, Medicare, Medicaid tax. So a $10,000 deduction to the company, and the kid receives a W-2 for $10,000, but you're not getting these payroll taxes siphoned off. And again, I can't overemphasize this. That's the key, because if you get those taxes siphoned off, they are not insignificant. They're 15.3% between the different taxes and the employer and the employee side. So if you do this in an S corp, pay the kid $10,000, you're at you're at $8,500 just after you get those taxes siphoned off. Now you're playing catch up on whatever tax benefit you get from it because you paid some extra tax just to do it. But done this way, you're shifting that $10,000 over. You get the deduction, and then your kid gets $10,000 of income with no payroll taxes taken out, and they're under the standard deduction. So they don't even have to file a tax return on that. They pay no income tax on it, and it's just a deduction. But all this hinges on setting this up to shift your income over, shift a portion of your income from your main operating business over to the family management company so that you can take some of these deductions within that family management company. So, okay, that covers that piece. The second reason, which I went out of order and called it the first reason, but the second reason why you would want to change around your income streams into and divide it up is for tax rates. And I'm going to talk about another example. This is actually a really recent one. We have a client who has a business that is doing very well, and it just kind of took off. So they have this S corp, but they're going to do about, go back here. They're going to do probably about $700,000 in profit this year. And that is, it has several problems. So the first one is their S corp is a pass-through entity. So all of this income is ultimately going to flow up to their personal return. Now, at the personal rate, they're going to pay 37% federal income tax, and then their state income tax is about another 10% because they're in a state with a graduated income tax rate. So they're paying almost 50% tax rates between those two businesses. And on top of that, they are phased out of this QBI deduction. So the QBI deduction is qualified business income. So if they made, like, up until this time, they generally have made around $300,000 per year. So on that $300,000 of business income, they qualify for this qualified business income deduction, which is 20%. So it's significant. So that's a $60,000 deduction for this QBI. And now on $700,000, because they're phased out of it. So let me go back here. The $300,000 ends up only, after we take that deduction off, now only 240 of it is taxable, right? That's the amount that they pay tax on. Then the 700,000 is all taxable because they don't get that deduction. So it's not like it caps out and they still get the $60,000 deduction, but nothing on top of that. They lose the 60. They're paying more tax in tax rate, and they have more taxable dollars because they've lost out on that deduction. So this person's business is one that has multiple different sites. They have multiple venues that they take care of. And because of that, it's very natural for them to split it up. So what they ended up doing is they said, like, for a lot of taxpayers, the peak efficiency for how much income you can take without getting into really punitive tax brackets and phasing out of these kinds of deductions is right around $400,000. And once you get above that, then you start to phase out and phase into these really high tax brackets. So what they did is they took, they knew this was coming, right? And so then they were able to set things up. They opened a new LLC. And that LLC they elected to file as a C Corp. And then they shifted the activity from one of these venues, the one that was performing the best. They shifted it into this new LLC. And so now we essentially have taken what would have been $700,000 of profit in their one LLC, and they've knocked that down to about $400,000, which is right where we want it to be. And they've shifted $300,000 over to the C Corp. Now, why would we do that? Because the C Corp is taxable at a flat rate of 21%. And I'll leave state taxes out, just to not muddy the waters right now. There's an additional wrinkle here where they get a benefit on the state tax side, but let's just not even talk about that. So they have shifted from from paying 37 cents federally on every dollar to only 21 cents on every single dollar for $300,000. So that is a 16% tax rate on $300,000. So they saved $48,000 just in the shift in tax rates. So let's see, I got to find a new color here. Let's go with orange. So their tax savings were $48,000 just in the shift in tax rates. But in addition to that, because their income was now under that threshold where they were phased out, they made this $400,000 eligible for the QBI deduction, where otherwise it wouldn't have been. So now on that $400,000, they have another $80,000 deduction that just reappeared because they got back under that threshold. So that's where this becomes really powerful. So now they have another $80,000 that went from being taxed at what would have been taxed at 37% to not being taxed at all. So they saved another it would round up to $30,000, but let's go low. So another $29,000 just by getting their QBI deduction back. Okay, so that seems worth it, right? We shifted $300,000 over, and we have saved now plus 48, $77,000 in total taxes just by shifting the income streams around. So this is why this stuff is so important. Now, within a C Corp, there are some restrictions. A C Corp can end up resulting in double tax if we're not careful about it. So we now have $300,000 parked over in this C Corp, but what do we do if they want to use that $300,000? Well, there are a lot of things that we can do. So the C Corp can loan that money back to the shareholder. It could loan the money back to, not even to the shareholder, to another LLC over here that's going to invest in real estate. So it could loan the money here. It could loan the money down here. We can handle the actual transfers of cash with a couple of these different loans and different loan options. The other thing we could do is we could have the C Corp directly make investments. So the C Corp could purchase real estate right underneath right underneath itself. And you could have the C Corp, it has assets, and then you make investments within that C Corp instead of just making those investments under your personal name. So there are lots of ways to accomplish this, but the key is you have now, under this scenario, an additional $77,000 to invest that you wouldn't have had previously, right? So instead of having, instead of having less money all in your personal name, you have more money. Some of it's over within a C Corp. It's not technically under your direct ownership. It's owned by the C Corp, but who owns the C Corp? You do. So you still have control over it. And that, when we get into advanced income tax structuring, that is one of the key principles, is understanding the difference between technical ownership and control. You want to be able to control any and all of the money that you have in different places, but you don't necessarily need to have direct ownership of it. You can own it through a trust, through another company like a C corporation, and understanding the difference between ownership and control is a key concept there. So those are the main ways in which we would split up income. Now, technically, how do we split up income? Well, I talked about this one, this one example where they had different venues, but there are lots of different ways to do it. One of the more common ways is, again, if we've got owner and then a single entity, even if we have two entities, there are three main strategies that we would employ, and then there are kind of subsets of these. So one is just breaking up revenue. That's the example we just talked about, where you kind of have multiple revenue streams anyway, and we just take one of them and move it over into a new business. Another one is like an intercompany service. And this could be anything, but most commonly it's payroll. So the most common example here is you would open a company that is handling payroll. That's a payroll processor. And that company is going, so any employees would work technically under this company. Alternatively, you can just have this company provide like a payroll and accounting service. And then this company might subcontract out other people to actually do some of the detailed work on that. But this is a payroll company that's providing a service to your main company and possibly even a service to your family company. And you have to formalize this into like real agreements and real pricing structures and actually set it up. It can't just be done willy-nilly, but it can be done. And that it doesn't have to be payroll. They're like marketing is another one, right? You could outsource your marketing, but you own the company that's doing that marketing. And so you kind of just break that out. A company that is servicing your main company in one of these main areas. So you can split up revenue streams, or you just set up a company that operates in service of your other company or companies. And now you're shifting income, money in the form of an expense from your main company and up to this new company. And so you still have the ability within reason to kind of have a nozzle that controls how much money goes up and transfers between those two companies each and every year. So that's the second way. The third way is with assets. And that is what we talked about with in the example of the rentals, where you actually have another company purchase assets and then lease or rent those assets back to your main company. So that would be the case where we talked about a commercial building that's being leased back, or if we're talking about again, vehicles or equipment, and you own those within a different company. They don't have to necessarily be down here. You could do that. The same thing. You could own those up here within a C corporation, and all of that will be very specific to one's individual circumstances and situation. But that's the third. It is the third approach. Assets. And those are the three ways that we technically go up. Once we've decided that we want to shift income between companies and break up those income streams, that's how we would technically go about doing it with one of those three methods. So I hope that this is helpful, at least to give the high level concept of when we would do this, why we would do it, and then what the tax advantages can be for it, and then also how do we technically go about doing it. So I want to open it up and go over any questions. If anyone has any, just feel free to raise your hand and I will let you know. And let's see. If not, you can put it in the, okay, Thomas asked a question here. In the example of the dentist, was the family property management company created under his original LLC or parallel to it? Great question, Thomas. So it would be in parallel. I'm going to go back. I'm actually going to start this new and just say, in general, whenever we're talking entity structures, we're going to have the 1040, which is where everything kind of meets. And then we've got this sort of invisible dotted line, and everything for ordinary income is on this side. So this would be the operating business, ordinary income, and everything for passive income would be on the other side. So these two entities are at the same level. For almost every taxpayer, it makes sense to have one single S corporation. And then sometimes you'll bolt on like a C corporation to that, like we just walked through. But for everyone, you'll want to have one single S corp, usually an LLC filing as an S corp, that you own 100% of. And then if you have additional entities under that, let's say you are a partner in another company or in multiple companies, that's fine. Those are all going to be down here. And if you form any other operating companies, even if like one of these might be like a sub entity that you formed for a totally different purpose. I don't know, a software development company when your main company is some kind of a service. That's fine. So you could have one that you own 100% of within that LLC S corp, or you could have one where you're a partner and you own 25% of it, and then the other 75% goes off somewhere else. You don't care. That's not under your umbrella. But all of these would flow under that one LLC. So one of the most common mistakes we see is people will have, they'll have their 1040, and then they'll have a whole bunch of different active ordinary businesses, maybe they're all S corps and they all are owned either 100, maybe one is 100% owned, and then another one is you're that 25% shareholder, and then another one is 100% owned. Now you've got 3 S corps. You've got a lot of redundancy in there, and everything is flowing up directly to you. So you have no buffer between those and your own income tax return. So what we recommend doing is having one that you own completely, that's right here, and then anything else is owned under that. And that way you only have at most on your tax return 2 K1s. One from this ordinary business, and then another one from this passive business. And it keeps your personal tax return very simple, lets everything else be consolidated into this one entity's tax return. And then now to your question on the family management company, yeah, it is, that's generally going to be a partnership, which is going to be more passive than active. So particularly if there's real estate in it, that's going to be over here on the passive side, because it's not an ordinary business. You have property and you're renting that property out, generally more of a passive activity. If it's personal property, that isn't always passive, but this company is generally more passive than it is active. So we would have another LLC over here. That's the family management company. And then again, you might have your real estate under this. You might have even another like investment in another passive, like if you have a passive investment where you've invested into another company and that company is giving you a K1, that might even fall under this entity. So you could have real estate, you could have, again, like I'll make another crappy vehicle drawing. You could have other vehicle. That one is crappy. You could have other vehicles under there. You could have your airplane under there, and have this kind of be the thing that owns have that kind of be the thing that owns the different assets that you have, but they are in parallel to each other. They're both in this on this first level where you own 100% of those, and then you stick passive things under that family management company, and you stick ordinary income things under the ordinary income category. That answer your question, Thomas? Okay. Yeah, just let me know if you have any follow-ups. Okay. Any other questions coming in? Thomas is our best participant. This is the second week in a row. Good question, Thomas. All right. I think if there are no other questions, we'll go ahead and call it. And let's see, maybe one more here. Thomas, do you want to raise your hand? And let's see. I'm happy to clarify. I want to make sure you get it clear. If you want to, we can have you. Okay, let's see. I think you just have to raise your hand and then you can ask. There we go. Allowed to talk.
Hi, Brian. Yeah, I appreciate the opportunity to ask and clarify.
Yeah.
I guess I'm just trying to translate this down to the more basic level as I'm just getting started up. But I envision eventually I could have this kind of structure like you're talking about. But right now I'm basically starting one LLC that I'm trying to envision as having like a bigger, will be like more like the parent and having things working underneath it eventually. But in the beginning, it's all going to be in one. So would that be a good way if I have this structure eventually in mind? Would that be the way to start, or is there a different way I should get started?
Yeah. You want to remind me what I know you have your main business in that LLC. Do you own any real estate or any assets within that LLC?
No,
Not
it's
right
all
now.
like service based and selling based type of thing.
Okay. So honestly, that I think you are okay with just that structure right now.
Okay.
The time in which you would want to think about, so you have your one main LLC and you may or may not be ready to go at that S Corp level yet. But eventually in the not too distant future, if you're not already, you'll have that LLC filing as an S Corp, but structurally, it doesn't change it. It's just a label that gets, that kind of gets tacked onto it, right? So The LLC is still the LLC regardless. And then that would be the LLC under which you would put any and all ordinary business activity. And in the more near term, I'd keep that as simple as possible. Everything that we're talking about is what we would do when we're trying to solve issues related to taxes. And until that time, let's say you even had two different business activities you were doing in that LLC, maybe somewhat related, but they're both kind of the main things that you're working on. I would keep them both in that LLC, and you can even use different DBAs or doing business as names.
That's what I was thinking. Yeah. Okay.
Yeah. So you can just do, DBA 1 and then DBA 2 under that LLC. There's no reason to like mess around with different. I'd keep the entity thing as simple as possible until you have to change it. And the triggers for you to change it would be, one, you want to invest in or purchase something that would fall under the passive category, right? So even that could be real estate, could be, one of these, like just like you wanted to buy a boat and we're trying to figure out a way to deduct it. That's the point at which we would say, let's have you open up another LLC that's over here on the passive side. But it would be for that type of purpose, not necessarily for like for another ordinary business thing that is kind of folded under the umbrella of your main company.
Gotcha. Okay. That definitely helps. And then as you're talking, like as things would grow and you would have a service that you could sell to either business, basically like what I do with web development, I could have that provided to the other entities.
Yeah. Remind me, Thomas, you're not married, right?
No.
Okay. So your threshold for this, because the numbers I was giving are generally for married filing joint. For you, if you're not married filing joint, then your threshold for that would be a little bit lower. So you would be, this will work for you up until right around $200,000 of income.
Okay.
And at 200,000, it's not like an exact number, but that's kind of the rough point at which you're going to start getting put into very punitive tax situations. So at that point, you'll probably want to start thinking aggressively about, all right, what do I do here to reduce this? Can I take some of what I'm earning and put it into real estate and then have that real estate help pull down some of this income and have it be deductible so that it goes into real estate and therefore I don't have to pay taxes on it. And I don't know if real estate's your jam or not. That's not the point, but the point is you would want to like slide something in here to divert money before it becomes taxable income up to you. And you may even want to do that before you get to 200K if you just have disposable income that you're like, well, I want to invest this anyway. I don't just want to throw it in the stock market. What would I do with it? Then we might want to have that conversation sooner. But it's at 200,000 that, mathematically speaking, you're saving 40, close to 40 or 50 cents on the dollar, right? You're like, I could pay 80,000 in taxes to the IRS, or I could invest that same $80,000 in an investment, and that investment after the tax benefit only costs me $40,000, right? So you get an $80,000 asset for a $40,000 cost. That's where this stuff really, really starts to get appealing.
Yeah, it's really interesting how this all works together, and I really appreciate that you open us up to these perspectives, because I didn't know this type of situation existed. So
awesome. Yeah. So just kind of keep that. Thanks. I appreciate that. But keep that number in mind, sort of that $200,000 number. As you start to approach that, that's where you really will want to think about these advanced structures. Until then, or until you trigger it with something else, like you just want to buy a rental property, even if you're not at that income level quite yet, then that might necessitate that. But until that time, I would keep this I mean, delete that. I would keep this as absolutely simple as possible and just have the single LLC and then pour all of your energy and focus, not into like managing and maintaining more than one entity, but just into growing and expanding this single entity.
That's fair. Yeah. And that LLC can just be like the umbrella and your actual operations can be with the DBAs.
Yeah, that's exactly right.
Okay.
The other reason why you would want multiple LLCs is for legal protection, to like divide it up and not have the liability from DBA 1 affect the liability from DBA 2.
Right.
Honestly, that's another one where it's like there's the technical piece and then the practical piece. And practically speaking, until you're at about that same threshold of like 200K ish in profit per year, there's not a lot to protect. And there's not a lot for anyone to go after. So there's not a lot of incentive. Like you still personally are protected from anything that happens in that LLC because of the legal barrier. So the only thing that is mixed here is DBA 1 and DBA 2. And until you get to that point, they're both so small that they don't really have big targets on them. And the hassle is not worth the benefit.
That helps a lot. Yeah. Thank you. Thank you. And you're talking about pre-tax or post-tax income on this?
I'm talking about pre-tax income, but that's after expenses, right? So not sales,
okay,
but sales minus expenses, giving you your taxable profit. That's kind of that's the number that we're referring to at that 200.
Okay, and I meant deductions. Yeah, but yeah, I see what you mean. Okay, so
yeah.
that's before.
Yeah, deductions. So after after deductions. So,
okay.
Deductions. We're saying deductions. I'll just use the more broad term of expenses, which would include deductions. So yeah, if you bring in 500,000 and have 300,000 in expenses and deductions, that 200 that's left, that's taxable income. That's the one that I'm talking about.
Okay. Thank you.
Yep.
Definitely appreciate it. Thank you.
Okay. You bet. All right. I don't see any other questions, so I'll go ahead and end it here. And thanks everybody for watching. And if you do have any questions, feel free to reach out either on the website or if you're in the community on the chat. And I will see you again next week. Thanks.